Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, February 10th, 2025. Economic activity last week. We're going to review the major data points, and we must say they are mixed. So over the last several months, we pointed out the fact that most of the time when we're going through economic data that was released the prior week, the numbers were solid to very good. I would definitely say this week is mixed. And we'll start off on a positive note. Last week, Monday, the ISM manufacturing number, again, 50 is the demarcation line between expansion and contraction. It was expected for January to come in at 49.8, but actually, upside surprise, came in at 50.9, which I believe is only the second time since COVID unfolded that the manufacturing index has been in the positive territory. So that was good. And the next day, we got jobs opening data, the JOLTS job opening report. For the month of December, it was supposed to come in with 8 million open and available jobs. That came in at only 7.6. And in contrast to that, the next day, the ADP employment change number came out. The expectation had been 150,000 new jobs added. They reported 183. And as we will see in a moment, that does not foot with the federal government's numbers. But on the same day as the ADP employment number came out, ISM services PMI came out, and it's been very strong, really, even throughout COVID. Expectation 54.3. It came in a little bit weaker, 52.8. Initial jobless claims then came out, and the expectation was 213,000, and it was a little higher than that. Nothing to freak out about, but came in at 219,000. Then on Friday, a slew of economic data. We were expecting this, the non-farm payroll. So the expectation was new jobs added in January, 170,000, but it came in at only 143. So in contrast to the ADP release, this was definitely a negative indicator in terms of employment strength. The unemployment rate actually dropped 10 basis points from 4.1 to 4.0. And again, the seesaw back and forth, while that is negative news in terms of the labor market, a positive news item in the same release, same time, I should say, average hourly earnings month over month was expected to be up 0.3%. That was actually up a full 0.5%. And again, in seesaw fashion, on the same day, the Michigan consumer sentiment number came out. Was expected to come in at 71.1. Downside, surprise, it came in at 67.8. So a very mixed set of data points last week. So with all that, I sort of expected the Atlanta Federal Reserve to pull down their estimate for GDP growth in the first quarter. However, no change. They still expect, despite all the news we got last week, GDP growth in the first quarter to be 2.9%. That's following a strong 2.3% fourth quarter last year. Inflation expectations didn't move at all last week. 10-year average still at 2.42%. In terms of the Fed funds rate, there's a meeting mid to late March. The expectation of no cut, now that has risen to 92%. It was 86% last week, so increasing conviction by investors that the Federal Reserve is not cutting rates in March and have taken down collectively the expectations for the entire year. So the odds now for December of 2 or more cuts, a week ago that was 51%. Last Friday that had moved down to 46%. Lastly, don't have a slide on this, but I'll just talk off the top. S&P earnings growth. This is super important for the stock market, U.S. equities to work. We do need certainly companies to at least hit expectation, but ideally beat expectations. So now, as of last Friday, we've got 62% of the companies that have reported earnings for the fourth quarter. Out of those, 77% have beat EPS estimates, which is above the 10-year average. But here's a really powerful number. These numbers are very impressive, at least to me. Coming into the quarter, the consensus expectation for year-over-year growth S&P 500 for the fourth quarter earnings season was at 11.8%. Companies have been reporting, they've been beating. That number keeps going up. So a week ago, it had gone from that 11.8% up to 13.1%. Now, based on such strong reported earnings last week, the expectation now is the fourth quarter last year is going to grow at 16.4%. Now, it could change, but that is a pretty impressive progression. And if we do end up at 16.4, because that's the best sense just after COVID in any world, 16% plus S&P 500 earnings growth is pretty fantastic. So, given all that news that we talked about last week, the fact that we feel is very mixed on the economic side, U.S. equity markets, very mixed as well. S&P 500 down 0.2%, equal weighted S&P down 60 basis points, NASDAQ down 0.5%. The international markets fared a little bit better. Last week, developed markets ex-U.S. up 0.3%, emerging markets up 1.4%. Fixed income markets here in the U.S. So it was mixed. The 2-year yield was up 9 basis points. However, the 10-year yield dropped 4 basis points, leading to an increase of 0.4% in the Bloomberg U.S. Aggregate Bond Index. So let's take a look at some of the earnings that are some of the economic data that will be released this week. Wednesday is a big day for inflation. We'll get the inflation rate, the CPI rate. We'll also get the core CPI rate. So for the headline number on a month-over-month basis, the expectation is for the month of January, prices increased 0.3%. Again, that's month over month. The prior month in December, it rose 0.4%. So investors are expecting a bit of a decrease in terms of the headline inflation rate. In terms of the core inflation rate for January, the expectation is the other way. It's expected to be up 0.3 basis points. In the month of December, it was only up 0.2%. On Thursday, then, we get the PPI, the Producer Price Index. We get the core. We get the headline number for both of those. For core PPI, the expectation for January is that it's going to be up 0.3%. Month of December, however, it was flat. And that's for the core. For the PPI headline number, it came in December at a positive 0.2. It is expected to increase to a positive 0.3. Jobless claims also announced on Thursday, expected to be at 216,000. We mentioned last week it was reported at 219,000. And lastly, retail sales ex-auto. That will be the key number that will come out on Friday. So retail sales ex-auto for the month of January expected to be up 0.3% for the month. In the month of December, the actual was a positive 0.4%. For retail sales, the headline number in December was also up 0.4%, but retail sales is expected, the headline number expected to be down 10 basis points month over month for the month of January. So that's it for an economic recap. We thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.